All right, Brad, let's start this week's 5 and 20. We collected some articles we thought were worth noting in the Wall Street Journal, Associated Press, and other places over the last week or so. I'm going to start with a good article out of the Wall Street Journal titled, "You Can't Invest Without Trading, You Can Trade Without Investing." And I find it, I'll just read a little section of it. It says, if you buy a stock purely because it's gone up a lot without doing any research on it whatsoever, you are not, as the journal and its editors bizarrely insist on, calling you an investor. If you buy cryptocurrency because, hey, it sounds like fun, you're not an investor either. If you buy financial asset because you have a hunch or just for kicks or because someone famous is hyping it, you aren't investing. You're trading. And they say an investor relies on internal sources of return, earnings, income, growth to value assets. A speculator counts on external sources of return, primarily whether somebody will pay more regardless of fundamental value. I think this is important because we're seeing some gamification of trading on many platforms right now.
We are. In a traditional sense, an investor isn't just buying the stock or the bond of a company that they choose. They're an owner of the company. And as an owner of the company, you own a share of the revenues, the profits, and that are distributed to the shareholders through dividends, et cetera. And that's an asset that can be bought and sold, in the public marketplace. As a trader, all those things go out the window. You're not interested in whether or not the company buys and makes widgets,
right,
or anything else. All they're doing is they're speculating on whether or not somebody's going to be willing to pay them more money for that in the future. Now, as an investor, you hope that the value of your investment goes up, but you're not necessarily trading it on a whim, based upon today's news.
Yeah, they point to, and we cover this later in the segment, but they point to frustration in that investors bought GameStop or investors sold GameStop today. And in reality, those aren't really investors. They don't care about GameStop's fundamentals. They don't care that you can buy a video game online directly from Xbox now. You don't have to buy it. You don't have to drive down to the store. They just want to buy it because they see it is, if they buy it at 50, someone else might pay them 60 for it. I think the average holding time was 40 seconds.
Well, I will say on the other side of that coin, they are providing liquidity in the marketplace. With their buying and selling, there's always a continuous flow of buying and selling activity of willing buyers and sellers. So what they are really trying to do is to figure out what the actual price of that security is worth, regardless of the fundamentals of the company, the pricing being who's willing to pay what at this moment in time.
Right.
Yeah.
Well, again, I think it's important for all people who are buying healthy long-term asset classes to focus on long-term, 10 plus years. You're buying it, you're reinvesting dividends, and you're focusing long-term. I think getting caught up in speculation is fun. Let's do it with a small amount of money on the side away from retirement money. I think that's an important distinction. And I think that's maybe what the author is trying to get at is let's don't call these people investors and make young people coming up today think that this is how you invest money.
That's right.
This is how you speculate.
And that they take that mindset with them forward
yes.
over the next 40, 50, 60 years of their life.
A lot of the stuff that we're reading about and makes the headline news is basically modern day tulips, which we talk about here a lot in the first crisis.
And a mania.
So you have to be careful with that.
Yeah.
Another article we found, breakup of big tech. I found this very interesting, that both sides of the aisle are looking at Amazon, Apple as, potentially Amazon may have to stop selling their product. So that you can buy an Amazon cable, you can buy Amazon cups, you can buy, the basic necessities. Amazon's kind of turned into the Walmart, where they have the Walmart brand, they have the Amazon brand, or you can buy other third-party brands. So what they're saying is, well, this is not quite fair to the other smaller businesses that are trying to sell. So you may have to split your company up where it's just a website for Amazon products and just a website for all the other companies.
It's just amazing how these companies have disrupted a traditional industry. And now we're beginning to see some of the significant developments that has occurred of it, and what to do about it. For some reason, some people in Congress think this is a bad thing. I haven't figured out. I know the new appointed Federal Trade Commission chairwoman has made indications that she's not happy with the state of the union relative to big tech.
I mean, Amazon right now has 158,000 products of its own. Another version of the bill would also say that basically a search engine cannot own a video service that has incentives to favor in search results. So basically, if you're a web search and you're searching and they serve you YouTube videos, well, that's a monopoly. So therefore, YouTube can never be served if you also, because you can't own YouTube. YouTube would have to be spun out from Google. Google can't be in YouTube business.
Yeah.
It can only be in search business.
Okay, so you can't. What they're trying to avoid is the search process being separated from the offer process.
Correct.
As a result of that.
Correct. Saying that there's a conflict there. They're powerful companies. I think during the election cycle, they, especially Google and Facebook and other companies, they tilted the search engine. If you're searching for, they wouldn't show you certain things politically. I think that made people on both sides of the aisle a little upset, and now they're trying to get them back.
Well, I can see where there is an
that's
opportunity
very
for
simplistic
them
version of this, but
to offer up certain products over other products on a search.
Right.
And that needs to be looked at and regulated and make sure that you have a fair playing field. But look, you walk through a grocery store, okay? You walk through Publix or Kroger,
right,
and you see how those products are displayed on those shelves.
Yeah.
That's not by accident.
No, and they're not cheaper by accident either.
That's right.
So
That's right.
It's
so it's
I don't know.
happening in the physical world as well as the virtual world of
Are they
retail.
manipulating what we see? Yes. Are they tracking our every move? Certainly trying to. I think what it comes down to is, are they using it to benefit themselves so that other people cannot compete? I don't know. I have a hard time believing that I can't compete on those platforms if I was in that industry. Now, who's cheering this on is like Roku.
Right.
So Roku's like, no, it's not a fair playing field. So I don't know. It depends on where you sit in the industry. If you're a smaller level tech, you want to see them break up so you have a chance to be the next big tech. But I don't know. Right now, they're saying that there's a chance that it doesn't move forward in the House. But anytime you have bipartisan support for something, you definitely have to pay more attention to it.
That's right. That's right. And I think that the managers, the business managers, big tech, are doing everything they can to assuage each side of the argument, saying that we're trying to be fair, we're presenting all the options, the numbers bear this out or the numbers don't. So
another article that actually this one was sent to us, SEC to review market structure as meme stock stir frenzy. This was in the Wall Street Journal, published last week. What's interesting is, in this short segment, it's hard to cover it in detail.
In great depth, right.
But when you have free trades, like on Robinhood, those trades are not entirely free. Those trades are also not exactly going to the New York Stock Exchange or the NASDAQ either. They're going to side exchanges, dark pools, as they call them.
Right.
And there's a couple of large players that the SEC seems to be targeting.
And those names keep popping up when they look at these things. Yeah.
Correct.
Yeah.
So, you might have a wide spread on something like a GameStop and extreme volatility, but what these third-party trade or exchanges will do is pay you for your trades. So, hey, Robinhood, you send me all your trades. We'll pay you X amount of dollars for your trades. The client, the end user, the customer, the trader is getting it for free, right? supposedly. I mean,
Commission free, transaction free.
It's transaction free. But what the SEC wants to know is, are they getting the best price, or is it marked up by a penny?
That's right.
Or 2 pennies or 3 pennies. And
now,
normally,
it may not seem like much, but when you do millions and millions and millions
and
and
more
millions of
volume
shares
that you provide the dark pool and trades, the more you get paid, which is why the SEC wants to look at platforms like Robinhood and say, are they gamifying trading for their own benefit?
Right.
Because it's not investing. We just covered that in the first section.
These are all related.
These are all related, exactly. So I don't know. From our perspective, when we go to trade, we're looking for the best execution. And so for us, we usually use exchange traded funds, right? And so we have the net asset value of that basket and what that ETF is worth. And then you have the exchange, the bid and the ask on the ETF.
Exchange. And it's called a premium or a discount, rather than not the actual price is trading towards its net asset value.
That's right. So there have been times that we've had to not trade through the market in order to get better execution in a dark pool. But most of the time, the funds that we're using, we're always getting best execution on the market. What the SEC is saying is, well, what if we didn't have dark pools at all? And what if it all just went to the market? So instead of only 53% of trades, I believe, actually get done on public exchanges. What if 100% of trades had to get done on public exchanges? Would it not be better for everybody? And
I don't know that's the question, because that's what they're doing is they're looking at something called the NBBO, National Best Bid and Offer, I think. And they're looking to see if in these dark pools or these third-party trading platforms, execution platforms, are giving as good a bid and offer as the public exchanges are doing.
Right.
And on the tight spreads, which means that the bid and the ask are very close to one another, there's not much to give there. But on securities that we see that where the bids widen from time to time, based upon an imbalance in buyers and sellers, there's where the opportunity is for these firms or these dark pools to make money based on that spread, because they bought it at one price and then they're going to sell it out at another price.
Right.
And given the fact that they paid for that order from another brokerage firm, allows them to accumulate shares.
And what people don't understand is you have trade, the settlements. So you place a trade. This is what got Robinhood in trouble with liquidity at GameStop, is you have a trade, but then that trade doesn't officially settle. What used to be for 3 days, now it's 2 days.
I remember when it was 5.
Really?
I teed that one up for you.
Yeah,
Casey.
you did. You did. Is that because of the dinosaurs that were disrupting the Earth? Or?
Well, they were slow. They made horrible delivery.
So the point is that the whole GameStop thing got stuck because there's liability sitting out there, and that liability, they needed Robinhood to pony up. It was a lot of money to cover any liability in case those trades couldn't get executed.
So now if you make
trade instead of trade plus 2, the trade date plus 2 days to settle, what if you went to trade plus 1 or trade plus 0?
Yeah.
So if you went to trade plus 0, maybe that eliminates more risk and the prices get tighter. But right now, that's not how it's set up. So it's very interesting. The people who are, quote, being investigated are all welcoming the investigation, saying, come on, let's show you how it's done.
Right.
Because if there's better pricing, it's good for everybody in the end, potentially. Maybe not the people who are doing the dark pools, obviously. But I don't think there's necessarily anything wrong happening, but we could see some system changes in the next year or two based off whatever they discover out of this. Or it is possible that SEC doesn't know what they're doing, and free market capitalism has already solved it.
That's
so
right.
I don't know.
It is the freest marketplace in the world, where buyers and sellers can get together and agree on a price, transact business, and move on your way.
So the next one is Boeing versus Airbus. There was an AP article talking about how the fight is over. It's always Boeing, who's going to sell more, Boeing or Airbus? And the fight's not really over. What's happened is Boeing and American production got upset with Europe because Europe was subsidizing the Airbus. So Europe could sell Airbuses around the world cheaper because they were subsidized by the governments in Europe. Well, some of the same accusations were thrown back at us from Europe. In the end, we ended up with lots of litigation for, I think, since like 2002.
For years, hasn't it? Yeah.
And people owe people money. And so evidently, the whole time we were here fighting, China has been figuring out how to build airplanes. In fact, part of the Boeing, I believe it was the 777, the wing, I think the wing structure, no, the 787 had the wing structure was all assembled in China. So basically we taught them how to build airplanes.
Right.
And they've learned. Mm-hmm. And what's interesting is they stopped during the pandemic. China stopped taking the airlines, state-run, stopped taking Airbus and Boeing deliveries, but they kept taking Chinese deliveries during that time period. So what's interesting is the big guys, Boeing and Airbus, have decided to stop suing and fighting each other, including the governments. And instead, they're going to turn their focus on China, because who's the biggest market for airplanes? It's the Chinese market. So what's going to happen is the Chinese manufacturer is going to keep perfecting the airplane, and then eventually the Communist Party will say, you can only buy airplanes from our manufacturers, and then no more sales will be going to Boeing and Airbus.
Right.
And they'll be self-sufficient on their own.
Well, that, and as if Boeing and Airbus continue, fighting, we'll say, and tariffs that are imposed on each one, artificially raise the prices. What will happen is, as over time, as the Chinese airplane manufacturers perfect it, they can come in at a lower price point.
Yep.
And begin to take world market share from other airlines.
Would you get on a Chinese-made airplane right now?
I don't know that I would, but Chinese have a very long period, thought process. So if they're looking 20, 25 years out, and maybe not be that long, they'll figure that Airbus and Boeing will continue fighting until then, artificially raising prices due to tariffs. So, it's not as if that Boeing and Airbus are going to strategically align themselves. Now they're just, lowering the tariffs or eliminating, portions of the tariffs to make the pricing more, visible, transparent relative to the actual cost of the airplane.
It's going to be a real battle, just like all the other industries have with China taking the product, making the product, and then all of a sudden they come out. They have whole Apple stores over there that aren't even real Apple stores. Yeah. They're just Chinese versions of Apple stores.
Yeah. Well, what's interesting here is that Airbus and Boeing, have probably corporately, competitively disliked each other.
Right.
But now they have somebody that they dislike even
more. Yeah. Maybe they'll get along. Yeah. Maybe the conversation goes, okay, if you're not going to buy it from me, just don't buy it from China. You can buy it from Airbus. Here's his business card. Yeah. I don't know if that's going to go that far or not. No, but very, very interesting. I used to say, if it's not Boeing, I'm not going. But there's so many Airbuses now, and they've been proven over the years that an Airbus is really good. It's more about the training of the pilot flying it. That's what it comes down to. And we've got that down pat here in the U.S.
Yeah.
Last bit, we only got a minute and a half. This will be a rapid fire corporate debt. So I saw an article talking about how bad corporate debt was, and you and I talked about a little.
Well, when you say bad, I mean we're on this podcast. I mean how it's expanded, how it's grown.
And why wouldn't it?
Cheap capital.
Yes. No, they did focus on airlines and cruise lines, saying they have.
Well, these are companies that had a very difficult time coming through the pandemic.
Absolutely.
They burned cash trying to maintain operations the best that they could. Now they've had to go out to the marketplace, and at a time when capital is as cheap as it is today, they borrowed as much as they could.
Yeah,
I think it was a smart move.
I don't think that it was wrong. I mean, they profile AT&T. AT&T hopefully is not the next GE. They have real assets and that will hopefully come through for them. But AT&T carries a lot of debt. I'm not saying we discount that, but if you look at corporate debt as a whole and how much it's risen during the pandemic, I don't know if that's a bad thing. If they're essentially almost getting the money for free, they're holding it, and if they don't need it, I bet you we see it go back down. To your point earlier, we're talking offline. Banks are basically saying, don't put any more cash in our companies.
it just goes to show how much cash there is out there in this marketplace today, in this economy. I mean, banks have literally worked with corporations to move cash off their books and into other instruments because the way banks are regulated and how much money they have to keep, relative to their loans. And we know that banks are not loaning out money.
Right.
As much. A lot of these corporate loans are done through the marketplace.
That's right.
Rather than through banks. So, and homeowners have refinanced their homes. So, I mean, a lot of the refinancing activity has gone on, strengthening personal balance sheets. And here, as we're talking corporate balance sheets.
Absolutely. All right, Brad. Good talk. Talk to you
Very
later.
good.